Welcome to the deep dive. It's really great to have you with us today.
Glad to be here. Ready to jump in.
Fantastic. So today we're really getting into the nuts and bolts, aren't we? We're going beyond just looking at price charts.
Absolutely. We're aiming to pull back the curtain a bit, look at the engine room, you could say, how prices actually get decided moment by moment.
Exactly. We want to unpack what drives those movements, the real forces, the supply and demand playing out live. We're calling it the price action mechanism.
It's about understanding the order book, who's involved, the different players, and maybe even some metrics that show more than the usual stuff.
Right. The goal here is for you, listening, to walk away with a much clearer picture of what's happening beneath the surface, beyond just watching lines go up and down.
It's fundamental stuff, really.
It is. And look, before we dive deeper, just a quick note. If you find these discussions valuable, if they help you connect the dots, please do take a second to like, share, and subscribe.
Yeah, it genuinely helps us keep doing these deep dives and exploring these complex topics together. We appreciate the support.
We really do. Thank you. Okay, so let's start with this core idea, the price action mechanism. How are prices actually formed? It's not like some committee decides, right?
No, definitely not. It's much more chaotic, or maybe dynamic is a better word. Think of it less like a static equilibrium you see in old economics textbooks and more like a continuous live negotiation.
A negotiation.
Between who? Between every buyer and seller active in that market at that moment. The price you see, that's just the very latest point of agreement, the last transaction price. But it's constantly under pressure to change.
So it's never really settled.
Not really, no. It's always in flux. This constant push and pull, this dynamic interaction, that's the engine of price action. It's happening right now, as we speak, in countless markets.
Like a perpetual tug of war.
That's a great way to put it. And the rope they're pulling on, the battlefield, if you will, is the order book.
Okay, the order book, let's unpack that. What is it exactly?
Imagine a live, constantly updating list for a specific asset, say a stock or a futures contract. On one side, you have all the buy orders. These are the bids. People stating the maximum price they're willing to pay.
Okay, the demand side.
Precisely. And on the other side, you have all the sell orders, the asks. People stating the minimum price they're willing to accept to sell.
The supply side.
Exactly. It's a real-time ledger of intention. Who wants to buy, who wants to sell, and at what price levels.
And a trade only happens when, what? When a bid meets an ask.
Exactly right. When the highest bid price becomes equal to the lowest ask price, a transaction occurs. A buyer finds a seller at an agreeable price.
Simple enough. But you said the price keeps adjusting.
Ah, yes. Because when a trade happens, those specific orders, the bid and the ask that matched, they disappear from the book. They're filled.
Consumed, sort of.
Consumed, yes. And the price then reflects the next best available bid and ask. If more buy orders keep coming in and eating up the available asks at a certain level, the price has to move up to find the next seller.
And if sell orders dominate?
Then they eat up the available bids, and the price has to move down to find the next buyer. The price is constantly shifting to reflect the immediate balance or imbalance between aggressive buyers and sellers consuming the orders in the book.
And the depth of the book matters too, right? Like how many orders are waiting at each level?
Hugely important. A deep order book means lots of orders stacked up at many price levels close together. A shallow or thin book means fewer orders, maybe with bigger price gaps between them.
Let's make this concrete. Say there's a sudden rush of buy orders trying to buy at $10. What happens in the book?
Okay, let's say the price is trading around $10.05, with asks starting there. If a bunch of new limit orders to buy pile up at $10, that shows strong potential demand if the price drops.
Right, waiting demand.
But now, let's say aggressive buyers start hitting the market now. They place market orders to buy immediately. These orders will start matching with the lowest asks, maybe at $10.05, then $10.06, and so on.
They're eating the supply.
Exactly. If they keep buying and clear out all the sellers up to, say, $10.10, the best ask is now maybe $10.11. The price is effectively moved up. If there's very little supply, very few sell orders, between $10.11 and $10.20, even a moderate amount of continued aggressive buying can quickly push the price all the way up to $10.20 to find the next significant batch of sellers.
Like climbing stairs where some steps are missing?
Kind of, yeah. The price jumps to where the orders are, and the opposite happens with aggressive selling. They consume the bids, pushing the price down step by step, or jump by jump if the book is thin.
So it really does boil down to supply and demand, just in this very immediate, granular way.
Fundamentally, yes. Supply and demand are always the drivers. But in the context of active trading, we see them made tangible, visible in the order book. Those buy orders, the bids, that's demand saying, I'll buy here. The sell orders, the asks, that's supply saying, I'll sell here.
And the balance is what pushes the price.
Constantly shifting. If you see way more buy orders piling up or aggressive buying hitting the asks compared to the sell side activity, that's bullish pressure. Demand is outpacing supply at that moment. Price tends to rise.
And vice versa for selling pressure.
Right. A flood of sell orders, either limit orders stacking up or aggressive market orders hitting the bids, shows increased supply or selling intent. That's bearish pressure, pushing prices down as demand gets absorbed.
You mentioned market differences earlier. How does this play out differently in, say, something super liquid like S&P 500 futures versus maybe a small, obscure crypto?
Oh, hugely different feel. Take the S&P 500 E-mini futures, for example. That market is incredibly deep. Massive volume, tons of participants, market makers constantly quoting.
So the order book is thick.
Very thick. Lots of bids and asks packed tightly around the current price. If a big buy order comes in, there's usually a substantial amount of sell orders right there to absorb it. Price might tick up, sure, but often quite smoothly because there's just so much immediate counterparty liquidity.
Like trying to push through a dense crowd.
Exactly. Now, flip to a small cap crypto or a penny stock with very low volume. The order book might be incredibly thin, maybe only a few small orders at each price level with big gaps in between.
Right, sparse.
In that scenario, one single moderately large sell order, maybe not even that big in dollar terms compared to the S&P, could wipe out all the bids across several price levels instantly.
Causing a flash crash, potentially?
It can, yeah. The price plummets because there was simply no demand, no waiting buy orders to absorb that sudden supply. The impact of a single order is magnified massively in a low liquidity environment.
That really highlights the importance of liquidity. Okay, let's nail down those core components again. Bid and ask. Define them simply.
Simplest terms. The bid is the highest price any buyer in the market is currently willing to pay for the asset. It represents the front of the demand queue.
Got it. Highest bid offer.
And the ask is the lowest price any seller in the market is currently willing to accept for the asset. The front of the supply queue.
Lowest sell offer. And the gap between them.
That's the bid-ask spread. The difference between that best bid and the best ask. It's a super important real-time pulse check on the market's health, specifically its liquidity.
So what's a narrow spread telling us? Like just one or two ticks difference?
A narrow spread signals high liquidity. Lots of buyers and sellers are actively competing, placing orders very close to the current price. It generally means it's easy and relatively cheap to get a trade done quickly without your own order significantly moving the market against you.
Lower transaction friction, in a way.
You could put it that way, yeah. Lower immediate price impact cost.
And the opposite, a wide spread. Big gap between bid and ask.
That indicates low liquidity. Fewer participants, orders are sparse. If you want to buy now using a market order, you have to cross the spread and pay the higher ask price, which might be significantly above the last traded price or the best bid. Similarly, selling means hitting a potentially much lower bid.
So your trades have a bigger impact.
Definitely. Each trade, especially larger ones, can move the price more noticeably because there just isn't as much opposing interest readily available in the book to absorb it. Trading costs, in terms of price movement, are higher.
Okay, clear. Mechanism. Components. Now, who are the actors in this drama? The market participants. The material highlights a few key types.
Right, different roles, different strategies. You've got sort of fundamentally the market makers.
Their job sounds straightforward. What do they actually do?
They literally make the market by providing liquidity. Their strategy is usually to simultaneously post both a bid and an ask in the order book, hoping to capture the spread.
So they're willing to buy and sell at the same time.
Essentially, yes, at slightly different prices. They aren't usually betting on direction. They profit from the transaction flow itself. They stand ready, ensuring there's almost always someone to trade with. This helps keep spreads tight and the market efficient.
And how do they place their orders?
Primarily using passive limit orders. Orders placed at a specific price, waiting patiently in the queue to be hit by an incoming aggressive order. They add liquidity to the book.
Okay, so makers add liquidity by waiting. Who takes it?
Those are the takers. These are traders who want to execute now. They typically use market orders.
Get me in or get me out right now.
Exactly. They prioritize speed and certainty of execution over getting the absolute best price. When a taker submits a market order, it immediately crosses the spread and matches with the best available passive order on the opposite side.
So they hit the orders the makers put out there.
Or other passive limit orders, yes. They consume the liquidity that's resting in the order book. A buy market order consumes the lowest ask. A sell market order consumes the highest bid.
And they're the ones causing the immediate price moves we see.
Primarily, yes. Think about it. A market order actively removes an order from the book. If a wave of buy market orders comes in, they remove asks. If they remove all the asks at one price level, the price has to move up to the next level where asks exist. So takers are the immediate force driving price discovery by consuming liquidity.
And the material mentioned large taker orders can break key levels.
Absolutely. A big enough market order or a coordinated burst of smaller ones can chew through all the resting orders at a support or resistance level, forcing the price beyond it. They provide the force needed to overcome those passive walls.
Which brings us to the whales. Everyone talks about whales.
Right. Whales aren't a distinct functional category like makers or takers necessarily. They're just any participant could be a hedge fund, a bank, a very wealthy individual whose size is large enough relative to the market's liquidity that their actions can significantly impact the price and the order book.
So just big players. Do they act like makers or takers?
They can be either or both. A whale might place a huge passive limit order, acting like a giant maker and creating a significant support or resistance level. Or they might need to execute a large position quickly and act as a massive taker, potentially moving the market substantially.
Do they try to hide their size? Dumping a huge order seems like it would get a bad price.
Good ones do, yes. They often use algorithms, iceberg orders that only show a small part of the total size, or execution algos that break the large order into many small pieces and feed them into the market over time, maybe across different exchanges, trying to minimize their footprint.
Sneaky.
But even then, a persistent large order being worked, even in pieces, can steadily absorb liquidity and influence price direction, especially if other traders detect it.
And they have the power to break those levels we talked about.
Definitely. If a whale decides they absolutely need to buy or sell a huge amount now, their taker orders can overwhelm the resting liquidity at key SR levels, punching right through them where smaller traders would bounce off. Their sheer size gives them that capability.
Okay, this is really connecting now. Let's tie it all together with support and resistance, SR. We see these levels on charts all the time. How do they actually form based on what we've discussed?
Fundamentally, SR levels are visible manifestations of the order book structure. The term order walls is actually quite descriptive. They are primarily built by market makers and those large participants, maybe whales acting passively, placing significant clusters of passive limit orders around specific price points.
So support isn't just a line, it's a concentration of buy orders.
Exactly. A support level on your chart represents a price zone where the order book shows a high density of bids waiting by limit orders. This signals substantial demand parked at that price. When price falls towards it, it hits this wall of buyers.
And the wall absorbs the selling.
It attempts to. As aggressive sellers hit the bids at that level, these large passive buy orders soak up the selling pressure. If the wall is thick enough, it halts the decline, causing price to pause, consolidate, or even reverse back up.
And resistance is the mirror image, a wall of sell orders.
Precisely. Resistance is a price zone with a high concentration of asks waiting sell limit orders. It's a supply wall. As price rallies towards it, aggressive buyers run into this block of sellers. The sell orders absorb the buying pressure, acting like a ceiling, potentially stopping the rally or causing a reversal downwards.
So passive orders build the walls, but walls get broken. How does that happen in the order book? You mentioned takers.
Right. The walls are built by passive liquidity, but they are almost always breached by aggressive liquidity by the takers, especially when it's large takers like whales or a sudden collective rush of aggressive sentiment from many smaller takers acting together.
Paint the picture for me.
Yeah.
Price is rising towards resistance at $50. What's happening inside the book as it breaks?
Okay, so at $50, $50.01, $50.02, you see a thick stack of sell limit orders. That's your resistance wall. Now, aggressive buyers start hammering the market with buy orders. These market orders instantly match against the lowest available asks, which are those at $50.
Eating the wall.
Eating the wall, exactly. They consume the sell orders at $50. If the total size of those aggressive buy orders coming in is greater than the total quantity of shares or contracts offered for sale at $50, then all sellers at $50 get filled. Poof. they're gone.
And the price.
Has nowhere to go at $50. It must jump up to the next price level where a sell order exists, maybe $50.01 or higher. If the buying pressure continues, it might chew through the orders there too. The resistance is broken because the aggressive demand simply overwhelmed the passive supply at that level.
Wow, so it's literally a battle of volume at that specific point. Breaking support is the same, just downwards.
Exactly the same mechanics, just inverted. You have a wall of bids at support. Aggressive sellers hit those bids with market orders. If the selling volume is large enough to consume all the buy orders at that support level, the buyers are exhausted and the price is forced down to find the next waiting bid at a lower price. Aggressive supply overwhelms passive demand.
This makes chart patterns feel so much more alive. You're not just seeing lines, you're seeing the result of these order book battles. Okay, what about the flip side? When the wall holds and price reverses.
That's when the passive wall does its job effectively. A reversal often happens when an order wall support or resistance is deep and strong enough to fully absorb the incoming wave of aggressive orders without getting completely consumed itself.
So let's take support again. Price falls, hits the buy wall.
Aggressive sellers are pounding the bids. But if that wall of buy limit orders is truly massive, maybe a whale has a huge passive buy order there or lots of institutional interest, it just soaks up all the sell orders hitting it. The sellers keep selling, the bids keep getting filled, but there are still more bids left.
The sellers run out of ammo before the wall breaks.
Essentially, yes. The aggressive selling pressure dissipates because it's fully absorbed by the passive demand. The price stops falling.
And how does that trigger the reversal upwards?
Well, seeing the level hold firm is a signal. Other traders see the selling was absorbed. This might encourage new aggressive buyers to step in thinking the low is in. They start hitting the asks, pushing price up. Also, the original large passive buyers who built the wall might see it held and start moving their bids slightly higher to defend the level or add to their position, further fueling the bounce.
So the defense holding turns into offense.
Often, yes, and the same logic applies at resistance. A strong sell wall absorbs all the aggressive buying. Price stalls. This encourages aggressive sellers to jump in, hitting the bids, and the passive sellers might start lowering their asks, reinforcing the downward move. It's a dynamic feedback loop.
This is fascinating. It really underscores how much is going on behind the simple price chart, which makes me think about traditional metrics, like volume. We're always told volume confirms the move, but based on this, it feels blunt, incomplete.
It really can be, yes. Traditional volume just tells you the total quantity traded, how many shares, contracts, whatever, changed hands in that period. It lumps buys and sells together.
So you don't know who was aggressive.
Exactly. A high volume bar could be lots of aggressive buying or lots of aggressive selling, or even just a lot of passive orders getting filled. It lacks directional clarity on its own. And maybe even more critically, it ignores the value of the trades.
What do you mean by value? Price times quantity.
Yes, the notional value. Trading 100 shares of a $10 stock is $1,000 of activity. Trading 100 shares of a $1,000 stock is $100,000. Traditional volume sees both as 100 shares.
But the impact, the capital commitment, is totally different.
Vastly different. Measuring only quantity can obscure the real financial weight, the force being applied by buyers or sellers.
There was that example in the material, a big red candle, price dropped hard, but volume was huge. Instinct says massive selling.
Right, that's the intuitive interpretation. But that high volume could actually represent huge aggressive buying stepping in to absorb the sell-off at those lower prices. Maybe smart money accumulating? Traditional volume gives you zero insight into that possibility. You just see activity.
Okay, so we need something sharper. This is where net liquidity comes into the picture, right?
Precisely. Net liquidity is designed to cut through that ambiguity. Instead of just quantity, it looks at the net notional value of aggressive trades.
So value of aggressive buys minus value of aggressive sells.
That's the core idea, yes. It calculates the total dollar value, price x quantity of trades executed by aggressive buyers, hitting the ask, and subtracts the total dollar value of trades executed by aggressive sellers, hitting the bid, over a specific period.
So it directly measures the net financial force of the takers.
Exactly. If net liquidity is positive, it means the dollar value of aggressive buying was greater than aggressive selling. Clear buying pressure. If it's negative, aggressive selling value was dominant. Clear selling pressure. It filters out the passive fills and focuses on who is actively pushing the market right now and with how much financial weight.
And this helps identify those smart money concepts like accumulation and distribution.
Immensely. Accumulation is often characterized by sustained positive net liquidity, even while price might be flat or drifting down. It shows consistent, aggressive buying, absorbing supply, suggesting larger players are building positions.
Buying quietly on weakness.
Potentially, yes. And distribution is the opposite. Sustained negative net liquidity, showing strong, aggressive selling pressure. Even if the price is managing to hold up or even crawl higher, it hints that informed participants might be offloading positions into buying interest.
Things traditional volume would completely miss.
Completely. Volume might be high in both cases, but net liquidity tells you the direction of the aggressive money flow that's actually driving that volume.
This is a game changer for analysis. It's like switching from a blurry photo to a high-definition video. And obviously you need tools to see this, right?
Absolutely. Visualizing net liquidity is key. That's where specialized tools come in. They allow you to perform, for example, candle level analysis.
Meaning you can see the net liquidity inside each price bar.
Exactly. You look at a candle on your chart, maybe a long-tailed candle suggesting a reversal off a low. With net liquidity data for that candle, you can see if it was actually driven by strong positive net liquidity, confirming aggressive buyers stepped in forcefully at the low, or if maybe the net liquidity was weak or negative, suggesting the bounce isn't well supported yet.
That adds so much context, and you can track this over time too.
Yes, you can do intraday analysis, watching the net liquidity flow build up during the day to see if buyers or sellers are winning the session overall. And historical analysis looking at daily or weekly net liquidity is incredibly powerful for spotting those longer-term accumulation and distribution campaigns we talked about, which are often invisible otherwise.
It really sounds like understanding and visualizing these flows is crucial. The material mentions tools like TickerChart, specifically for this kind of analysis.
Yes. Tools like TickerChart are designed precisely to visualize net liquidity and other order flow metrics, giving you that deeper insight. For instance, AccumulationPro TickerChart Professional Edition uses algorithms built upon these very market dynamics, analyzing taker activity, net liquidity, order walls, to provide signals that traditional volume just can't offer. It helps quantify that battle between buyers and sellers.
Wow. Okay, let's try to summarize this incredible journey. We started with the price action mechanism, this dynamic real-time negotiation in the order book.
Driven by raw supply, asks, and demand.
Right. We met the players, market makers providing passive liquidity, takers consuming it aggressively and driving price, and whales whose size lets them significantly impact the book.
Then we saw how support and resistance levels are essentially walls of passive limit orders built by makers and large players.
And that these walls are broken by aggressive takers, often whales, overwhelming the resting orders. Reversals happen when the walls absorb the attack.
Understanding these concepts truly is foundational. It moves you from just observing price to understanding the forces creating price. Tools that leverage this data, like the ones from AccumulationPro, can definitely help apply these principles.
It provides that edge, doesn't it? Knowing what's under the hood. And as you mentioned, combining this understanding with solid risk management is key for navigating the market successfully over the long run.
Absolutely. It's not magic. It's about understanding the mechanics and managing your exposure. You can learn more about data-driven approaches and risk management at AccumulationPro.com.
Definitely worth exploring if you want to deepen this understanding. So we've peeled back layers today, looking beneath the simple price chart. It makes you wonder, given how much we've uncovered, just by looking beyond traditional volume and basic SR, what other commonly used indicators or metrics might also be simplifying or maybe even obscuring the complex reality of market dynamics happening just below the surface?
That's a great question to ponder. What else are we missing by just looking at the standard toolkit?
Something for all of us to think about. Thank you so much for breaking all of this down today.
My pleasure. It's fascinating stuff.
And thank you all for joining us on The Deep Dive. We'll see you next time.